Hello, everyone, and welcome to the Basepoint Wealth Investment Update and Outlook webinar. My name is Katie Orkes, and I'm the Director of Operations and Chief Compliance Officer at Basepoint Wealth, and I am your webinar host today. We thank you for taking the time out of your busy schedules to join us. But before we get started, I have a few housekeeping announcements. To protect your privacy, all participants will remain muted for the entire webinar. For those of you joining us via the web conference, at the bottom of your screen, there is a Q&A icon. We will have a brief question and answer period at the end of this call. If you have a question during the presentation, please click the icon, type your question in the window, and click send. Whatever questions are not answered during the call, we'll respond personally offline. If you're joining us via phone, or if you have a specific question about a holding in your portfolio or an aspect of your financial plan, we encourage you to contact your advisor directly, and they will be happy to answer your question. This webinar is being recorded. We do have a brief disclosure slide, which you can review in further detail when the replay is made available. With no further delay, I will pass the mic to Alan Wallace and Landis Wiley to begin our presentation.
Great, thank you, Katie. And thank you to everybody who's joined us today. My name is Landis Wiley. I am one of the 5 founding partners of Basepoint Wealth, and I will be serving as the moderator for today's event. In a moment, we will get to Alan Wallace, Chief Investment Officer of Basepoint Wealth. Most of you on the attendance list today are clients of advisors at Basepoint Wealth. You're likely familiar with the company and the process. For those that may be newer to our firm, we appreciate your business and thank you for your trust and loyalty. A little background on Basepoint. We are one of Iowa's largest fee-only fiduciary registered investment advisor firms. We are locally owned and managed. There are 5 partners that own Basepoint Wealth, all located in the Cedar Rapids, Iowa area. Currently, Basepoint is responsible for the management of over $500 million of client assets, primarily located in the upper Midwest, but scattered throughout the country. What makes Basepoint unique is its collaborative team-based planning focus and its principles-based investment management. We've recently added full-service tax and accounting for those clients that need those services. Today's presenter is going to be W. Alan Wallace, Chief Investment Officer and Managing Partner of Basepoint Wealth. Alan has been in the financial industry and in the investment space for over 20 years, entering the business right around the time of a very well-known period known as the tech bubble, and has experienced a number of unique market circumstances over his 20-year career. With a background in finance, economics, and accounting, and a lengthy list of accreditations and credentials, Alan continues to stretch his educational prowess on a daily basis and is the one responsible at the firm for overseeing the wealth management and investment management strategies implemented on behalf of our clients. Alan is married to Kate Wallace, co-founder and president of Basepoint Wealth, and they reside in Marion, Iowa. So without further ado, we're going to shift over here and start into our presentation. Alan, before we kind of get too far into talking about what's going on in today's markets and the economy and portfolio management, I thought maybe a good place for us to start would be for you to give just a little bit of background on the Basepoint Wealth management process and ultimately how investment management, the topic of today's presentation, really fits in as a piece of a much larger puzzle focused on protecting and growing total wealth for clients.
Yeah, Landis, that sounds great. And thanks for that kind introduction. Making a mental note for smaller pictures of me on the presenter slide going forward. I want to thank everyone for taking time out of your lunch break to let us opine about what we think about investment management. And we also want to thank you for your trust in helping you define and reach your financial goals. Investment management is just one piece of a greater puzzle, and we've designed it to understand your goals, your objectives, what limitations you have, and to ultimately help you maximize your wealth over your lifetime. And that's really what our goal is here, is to help you over your entire lifetime, and in many cases, the lifetime of your children, right? So it's not just about making as much money as we can each quarter. Basepoint is principles-based and process-driven. We use our principles in order to formulate a process. And when most investment advisors think of investment management, they think of two areas: asset allocation and investment selection. You come in, you say your age and your risk tolerance, and then they pull out a pie chart, and then they put some mutual funds in order to come up with an investment portfolio for you. At Basepoint, our process is a lot more detailed than that. We go through your goals, we identify your return requirements and your willingness and your ability to take risk. Those are the things you work with your advisor. And then the investment department determines an appropriate asset allocation within the constraints that you've determined. And then we select securities. And then there's a whole nother back half to this between how to trade and how to rebalance and monitor, and what are the important things that we look at in performance evaluation. So I just wanted to sort of couch that with the fact that today we're talking about two small pieces of our entire wealth management process. As I said earlier, we're principles based, and principles are things that we consider to be objectively true. These shouldn't change over time. Our process, we may find errors or we may find things that we can improve on, but our principles should last for your entire lifetime. And so I do think it's always good to just run through the principles when we're having a call like this, just so we can all take a step and make sure that we're on the same page. But I won't go into too much detail because I've written extensively about these principles on our website. So if you're ever curious or bored, you can go on our website and sort of see what the literature is on why we think these are the 7 most important considerations in investing. And this goes back hundreds of years. These aren't things that change over time. These are things that have been true since the 1800s. And even though the characters change and the circumstances change, there's really nothing new under the sun in investing. It's all the same stuff, just happening in different ways. But first and foremost, we want to carefully contrast investing versus speculating, right? We don't speculate with client money. And I define an investment operation as one that guarantees, or that is expected to have adequate income, and that you expect to have safety of principal. So sometimes return of your money is more important than return on your money. And we want to be able to differentiate between those two. Speculation typically means you are going to buy something and then hope you can find someone else to buy it for more money later. And we've tried to avoid those situations because there's no way for us to carefully calculate when we're in a speculative situation how much we're going to make over time. Number 2 is we always try to invest with a margin of safety. If you're gonna build a bridge to carry 10,000-pound trucks, you actually try to build it so that it can hold 30,000 pounds. You don't want to build it for exactly the limit at what your target is. And we do that with investing too. We try to make sure that even if we're wrong, we have such a margin of safety that we're still going to be in a good position. We define risk as permanent loss of capital. The entire financial industry just determines risk as fluctuations. We see fluctuations as things that we can take advantage of. When stock prices are down, that makes us want to buy them, not sell them. It always sort of tickles me that when stocks go on sale, people buy stocks, but when stocks go on sale, people panic. And we try to always be willing to help our market participants unload their securities at cheap prices. Number 4 is we carefully manage liquidity. If we can make sure you've got adequate cash to meet all your needs, then we never have to worry about selling into a downturn. Also, if there is a downturn, then we've got some ready cash to go to in order to take advantage of lower market prices. Number 5 is that we always think long-term. This is a continuous, temporal, stochastic system. Those are just fancy words that means that random things happen, and we have to sit around and be patient and wait to find out what happens. And so, if we try to measure ourselves on a quarterly basis, we're not giving ourselves enough time to have good decisions pay off. And as I said earlier, we're managing your money for your lifetime, not for the next 6 months. Number 6 is careful use of diversification. There's a Greek physician named Paracelsus who said that all things are poison in the wrong dose, including oxygen and water, and we feel the same way about diversification. You can have too much diversification so that the careful selection of securities doesn't matter. You own too many things for good decisions to pay off. And then finally, careful consideration of costs. We want to know what we're paying for. That doesn't mean that we want to indiscriminately cut costs. Reducing our management fee from 45 basis points to 40 basis points, if we're giving up 4 analysts on the team, is probably counterproductive. So we want to view costs in terms of what we're getting for the money and make sure that it's worth it.
Great, thanks, Alan. So let's build on this a little bit and maybe talk about how our principles guide you and your team in the portfolio construction process. As I think you've alluded to here, portfolio construction obviously is quite a bit more than just picking a stock or a mutual fund or an ETF or a bond or a Bitcoin or whatever the thing may be. So let's maybe take a few minutes here and just talk through this process of actually constructing a portfolio and how you're going about looking at that situation.
Sure, yeah. So, I mean, there is a misconception out there that portfolio management is just limited to picking stocks. And that's really more on the client side. I mean, I think most advisors intuitively understand that you have to determine an asset allocation also, but there are really 3 steps. There's the asset allocation, which is how your how the portfolio is broken down in terms of larger security classes. Then there's security selection, which is the individual components of the portfolio. And then there's a third that most people forget about called asset location. And that is, can we optimize your tax situation by putting certain asset classes in different tax status accounts? So the first module of that building a portfolio is asset allocation. And that's determining the broader asset classes. So we break ours down into 4. There may be other methodologies, but we look at cash, bonds, stocks, and then sort of what we call alternatives or things that aren't those other 3. So we may have things like precious metals or sometimes real estate or strategies that may use stocks or bonds, but aren't long only. They may use short strategies, or they may use leverage strategies. Our asset allocation starts at a baseline of 60% stocks and 40% bonds. I always like to joke around that, why use math when common sense will do? And the reason that works out for a moderate investor is that if you think about distribution rates, if you distribute 4% of your account each year, 40% in conservative assets would last you about 10 years. And if you think about the way that stock prices appreciate, at an average return on stocks of about 7.2%, your stock should double every 10 years. So what you have is you have a system where you're liquidating 40% of the account for your retirement needs, but you're doubling 60% of your account over that same time period for growth needs. And what that does is it allows your portfolio to grow over time, even while you're taking distributions from the account. And so we take the planning module and the investment policy statement constraints, and we apply those to an asset allocation based on a client's age, willingness to take risk, ability to take risk, and the need to take risk. And those are really 3 separate things that need to be evaluated. You might be able to take a ton of risk, but you feel conservative. And when the market goes down 5%, it makes you uncomfortable. Well, we have to take that into consideration when we're building your portfolio. And on the other side of it, you may be highly aggressive, but you have so much money that the only thing that can hurt you over time is loss. And in that case, maybe taking less risk is more prudent. So, and this is just sort of a sample at the bottom that shows the way that we may break down a base allocation that would then be altered based on a client's unique circumstances. So once we've determined an appropriate asset allocation, we know how much cash and equity and bonds and alternatives we want to have, then we have to start to look at security selection. And security selection is where we decide whether we're going to use individual stocks or mutual funds or bonds, or there are hundreds of thousands of investments for us to choose from out there. There's something like 20,000 mutual funds and 300,000 bonds to pick from. There's 41,000 stocks in the United States, and that's not even counting the 3,000 or 4,000 hedge funds and private equity funds and all those other things that are available to accept your money. When we're selecting mutual funds, we have three major criteria and then a fourth. This is based on a letter that Warren Buffett wrote to Katharine Graham in the 1970s. And he was trying to explain to her how the Washington Post should manage its pension fund. Back then, the financial industry wasn't built out the way that it is today. And so he was trying to give her some real advice on how to select investment managers to manage the pension fund. And it's a 19-page letter. I recommend reading it if you ever get the chance. But if you boil it down, he said you should have concentrated holdings. So in other words, don't pick managers that have way too many stocks for them to even track. And if they have too many stocks, if they're really good, then you're not getting the benefit of their selection criteria. They're watering themselves down. Low turnover, so they don't have to buy and sell a lot. They pick things well on the beginning. That does two things. First of all, it lets you know whether they've made a lot of bad decisions. And second, it keeps costs down because every time you trade a stock, a broker gets a commission, a little bit like an angel getting its wings when a bell rings. And then you want to have smaller managers. There is definitely a drag on large managers. The bigger you get, the harder it is to perform well because your selection set of securities gets smaller and smaller. And then finally, we want the manager to use some sort of fundamental analysis to calculate a fair value and buy at a discount. That sort of makes sure that our first two principles are being adhered to by our fund management. If we're looking at individual stocks, then we're looking at stocks that are trading at a discount to fair value. Right now, we use Morningstar. Over time, we'll want to in-house more of the valuation activities. We want to have an economic moat, which means that the company is expected to earn high returns on capital for 10 to 20 years. And we sort of use that as a safety valve so that when the company is reinvesting money back into the business, we know that it's a good business. We then use Value Line to confirm our valuation statistics so that we're not looking at a single point. And if Morningstar's been overly optimistic, we have a check for that. And then once we've done that, we've narrowed it down to the companies that we may have interest in. Then we analyze the business fundamentals, management performance, and the industry dynamics to make sure that the company is poised to have high returns on capital over time. So this is just sort of a quick look at how all those things I just talked about would translate into a real portfolio. Obviously, we don't want you to run out and buy this because this is not catered to your individual needs. This would be a moderate portfolio for an investor with very low constraints, right? So we haven't worked any constraints into our base allocation. That's done with the advisor and the investment team to decide, you know, if you have some stocks that you inherited that you don't want to sell, or you definitely don't want to have anything in the defense industry, those kind of things. So this doesn't take any constraints into consideration, but it just gives you an idea of how we translate those four asset classes into a real portfolio. And then finally, we look at asset location. So we want to put asset classes into the type of account that gives us the best advantage. So we may want to take our bonds and put them in more heavily in pre-tax accounts. We may want to take our stocks and put them in non-qualified accounts because they have capital gains treatment instead of ordinary income treatment. And then we may want to take the more aggressive things like international and smaller companies and put them in Roth IRAs or tax-free accounts so that we can take advantage of that tax-free growth over time. And this is a strategy that seeks to maximize your after-tax return over time. And, you know, it's typically overlooked by most individuals. And, you know, it goes to this concept that we can add a lot of value to your portfolio through our planning strategies that aren't even related to the asset management strategies.
Great, thanks, Alan. That was, I think that was a great coverage of kind of the pieces that go into the work that you're doing, aside from just picking and choosing the tickers that folks may see on statements. Let's, if we can here, maybe take a moment. Let's take a little deeper look into that investment selection criteria and maybe how that is actually expressing itself in terms of some of the funds that you're using, as well as maybe that list of stocks that you're monitoring and perusing on a daily, weekly, monthly, quarterly basis that ultimately may make their way into client accounts over time.
That sounds great. So this is just a look at three of our largest holdings at Basepoint. We've been using these funds for anywhere between 7 and 10 years. We don't change very often because we try to do a good job of selecting them up front. But what I want to point out is that if you look at how many holdings these funds have, they're very small. And I apologize that my circles are way off there, but you can kind of get the idea of what I'm talking about. So Smead Value has 26 stocks, Ocre Focus has 22, Madison Midcap has 29, and you can also see they have very low turnover. So we save money on trading costs because these funds are not turning their portfolios over so frequently. The average mutual fund has 191 holdings. Our average is 28.6. So if you take our entire portfolio of mutual funds, it has about the same number of holdings as the average fund out there. And we typically see this when we evaluate external portfolios. They might have 12 mutual funds, but they own, 6 of them own all the same stocks. So you're not getting any additional diversification. And worse, they're concentrated in 10 holdings, which we'll talk about a little later when we look at the market dynamics. But you end up with a portfolio that has thousands of stocks in it, but still 30% of the exposure is focused in 10 or 15 companies. So shifting gears a little bit, when I look for a portfolio of individual stocks, I try to base it on what the company is earning and what the company is worth in relationship to what the price is. So this is a kind of a messy spreadsheet if you don't know what you're looking at, but the things to focus on are the fair value and the earnings yield. The earnings yield tells us basically what percent return we're getting on the company in terms of earnings. And that's really important because a company can do a couple of things with earnings. They can reinvest them back in the business, they can pay them out in dividends to you, or they can buy back shares of their own stock. So over time, earnings really do matter. If you think about owning a savings account at 5%, it's going to grow by 5% a year no matter what happens. Well, earnings aren't quite like that because we can have management that doesn't do a good job of determining how to distribute those earnings. So that's why having able and competent management is so important. But what ends up happening is we break this down as if we own the entire company, and then break that down into a portfolio to determine what is our discount to fair value. So in other words, on this portfolio, every dollar that we buy in stock is really worth 22% more than that. Or in other words, we pay 78 cents for every dollar worth of value. So you can see you have a portfolio that we invest 220,000 in, but it's really worth 284,000. And then we can also see what we're yielding in terms of earnings. And in this case, we're yielding 5.65%. Now, if you look at the 30-year Treasury, you're getting 1.9% on a 30-year Treasury. So we're yielding almost 3 times what you could get on a 30-year Treasury. Later, you'll see that on the S&P 500, you're getting closer to 3%. So we're almost doubling the yield on the S&P, and the S&P is also not at a discount; it's at a premium. So just a little bit of a window into how we view individual stock selection.
Great, thanks for that, Alan. So let's take a little shift in the conversation here, and I'm sure what's on top of mind for a lot of our attendees today is what in the heck has happened over the last 3, 6, 9, 12, 24 months in terms of the economic and investment landscape, and maybe some thoughts about where circumstances sit today. So I think as we go into this, top of mind for a lot of folks is that 2021 has really been kind of dominated by four underlying themes. And you can correct me if I'm wrong as you talk about this, but really it's been conversation around the inflation and the Federal Reserve and their actions that they have taken or have not taken. Sort of questions around what are things worth. Markets obviously continue to hit record highs. Questions about is that sustainable or even sensible that we're there. Looking maybe a little bit at some market cap weighting. I know this is something that you spend a lot of time discussing, and in a number of your writings, you've gone into this topic, but maybe talking about how the markets are not necessarily representing what's really going on in the world. And then a question that's come up lately, as every day the markets seem to go green or they go red, is whether or not maybe we're in something that might be referred to as a hidden correction. So I know you always like to talk about differentiating what's what is signal versus what's the noise, and trying to make sure we're making the decisions, or you're making the decisions based on what's true. And so if you could, let's maybe just dive into this and hear your thoughts on it.
Sure. So first and foremost, there's always the question of, hey, should I be super aggressive right now, or should I be a little bit more careful? And I just want people to get their bearings here and think about how much more impactful permanent losses are to your success than short-term gains. There's a misconception that stock market gains are coupons to be clipped like a bond, right? So if you own a bond that's paying 6%, you have $1,000 in it, you get $60, you put it in your pocket, and you can do something else with it. Well, stock returns are not like that. Bond returns are discrete. I mean, in other words, there's only a certain range of outcomes that you can have in bond returns. Stock returns are continuous, and that means that there's an infinite number of outcomes. And so discrete data can be counted, but continuous data can only be measured. And if you think in terms of, at the end of the year, I was up 20% on stocks, now I can put that money in my pocket and spend it on something, that's not the way it works. That money is still at risk. That money is still just as likely to be returned to the market as it is for you to compound it over time. So if you think about just the mathematics of the way returns work, and this is kind of a confusing little chart here, but if you look at a 6% return versus a 12% return, everyone's always saying, hey, it really matters if you get that extra 2%. Well, it does over time, but it doesn't when the returns are random and when they're continuous. So if we were dealing with discrete data, then I would agree with that an extra 2% is a really big deal over a long period of time. But at a 6% return, after 9 years, you've got $16,000 on a $10,000 investment, and you've got $27,000 if you receive a 12% return. Now, if you get a 50% loss on the 12% return because you were stretching a little too far and you were buying something that was risky, and you'll see that a 6% return actually beats a 12% return if it ends in a 50% loss. So that's important. So that's why we focus on hitting singles and doubles and not swinging for grand slams every year. And it's really important to remember that a 50% market loss takes away 10 years of returns at a 7.2% rate of return. That's based on the rule of 72, right? So if you divide 72 by your interest rate, it tells you how many years it takes for a given amount to double. And that's what this little growth of $10,000 at 7.2% is. But what that means is that half your money has always come in the last 10 years. And so that 50% market loss takes 10 years of returns away from you. And we're not talking about volatility. We're not talking about fluctuations. We're talking about permanent losses. So for instance, if you bought Cisco Systems in 1999 at 100 times earnings, you still haven't made your money back 21 years later. Matter of fact, for every $1,000 you've invested, you only have $800 right now. And the other thing is that at a 50% loss, your distribution rate is doubled. So distribution rate means what percentage of my portfolio am I taking out every year? And there's this thing called the Trinity study that looked at the probabilities of success at different distribution rates. And what you can see is that at a 4% distribution rate, you have a 92% probability of success. That's very high. But if you lose half your money and your distribution rate doubles to 8%, you have virtually eliminated your probability of success. So losing money is much harder on your ability to succeed than making small, short-term temporary gains. Clear my annotations up there. So let's take just a quick look at the current market conditions. So there's been large liquidity flows for monetary and fiscal policy. And there's some confusion here on what the difference between monetary and fiscal policy are. Monetary policy is when the Federal Reserve buys and sells things and creates additional cash. But they're not really injecting that cash into the hands of people that are going to spend it. They're buying bonds and putting them on their balance sheet and exchanging them for cash. So really all that does is it forces investors up the risk curve, and it creates asset inflation. Fiscal policy is when the Congress sends money to individuals, right? So it sends money to people that are going to spend it. So that creates goods inflation. And asset inflation and goods inflation are really opposite. So for the last 15 years, we've had monetary inflation, and asset prices have gone up exorbitantly, and we haven't had any goods inflation. But now that fiscal policy is starting to stimulate, you're seeing goods inflation start to pick up. Historically, that's been bad for asset prices. So we did have a print of 6.2% in inflation. Inflation normally leads to increased interest rates because people demand higher returns to delay spending because they expect future prices to be higher. And then increased interest rates are normally lead to lower bond and stock prices. And if you look at the little chart in the gray, I know it's kind of hard to make out what's going on there, but it looks at all the periods of inflation. You see, it's been a long time since we've had any sort of inflation, but there was only 1 year where returns were positive after a period of inflation. That was 1951. But we're currently at 6.2% inflation, and our markets are up 40.8%. And if you look, that is an anomaly in comparison to where all these other cycles have sort of ended up. So the question is, all right, well, that's fine, there's inflation, but is the market reasonably priced? And again, we never focus on timing, we only focus on valuation. And as you can see, so price to sales is just based on the revenue of a company. So this is the S&P 500, the price to sales ratio. Right now, the S&P 500 is 3.17 times sales. That peaked at about 2.8 during the tech bubble. So we're actually well above where the tech bubble even was. So on a sales basis, the market is very high. Earnings yield, which we talked about that concept earlier. Right now, the S&P's earnings yield is 3.42, which is not that much higher than what you can get on a 30-year Treasury. That's not that great of a deal. The Shiller PE ratio looks at the last 10 years of earnings and then tells us what our price to earnings ratio is based on 10 years of earnings. And you can see we're at 38.95, which was only surpassed one time going all the way back to 1870. So we are definitely at historically high prices in the S&P 500. Now, that doesn't necessarily mean that has any bearing on the other 41,000 stocks that are available in the world. Because the S&P 500 is market cap weighted. And what that means is that the largest companies have the highest weight. So the gray spreadsheet in the bottom right corner sort of breaks down what your money is in if you own the S&P. And you can see that 30% of your assets are actually concentrated in the 10 biggest holdings, 8 of which are technology companies, which if you go back to 2000, that was another period of time where technology stocks were sort of dominating the market. But so this capitalization weighting is sort of a double-edged sword. At the tail end, when the market is going higher, it causes the increase to accelerate. But when the market is going the other way, it actually causes a decline to accelerate because the largest companies are losing money fastest. So how does that market cap weighting influence our perceptions? Because we feel like we should just be able to take a look at CNBC and see what the S&P is doing and then have some sort of litmus test for how our portfolios are doing. But unfortunately, it just doesn't work that way. Because of the market cap weighting, you can have a wide divergence in how the securities in the portfolios are performing. So as of December 10th, 5 technology firms accounted for more than half of the S&P's 12% return. So if you did not own those 5 companies, your return was half of what the S&P was. And for the year, it was more than a third of the return. So if you don't have exposure to those overvalued companies, your returns have been significantly lower. If you look at the entire global equity set of 41,000 stocks, if you take out the 300 largest growth stocks in the US, the return for the year has been 1.6%, so flat. And so you get in this position where you have to own things that you don't really want to own if you're going to have returns that match the market. One of the problems that we've had is that our returns were very heavily weighted prior to June 1st of this year. This is a chart of an average return from a Basepoint client, and you can see that the returns were extraordinarily good until June 1st. And what happened around that date is interest rates started to drop again. So interest rates were rising in anticipation of inflation in the first 6 months of the year. And then the Fed came out and said, hey, there's no inflation, or it's transitory, or all these things. And when rates started dropping again, these are longer term rates, 10-year and 30-year treasuries, we were positioned for rising rates and inflation. And so you can see that we've had sort of flat returns over that last half of the year. So is there really a correction underway? Typically when markets peak, it's not symmetric. There's wide dispersion in returns. So the smaller companies start to drop first. If you look at the NASDAQ, it's 6% from its record high, but 68% of the companies are down 20% from their 52-week high, and 40% of the companies are down 50% or more. So there has been a broad decline in equity prices that aren't those top 10 or 15 or 20 technology stocks. And if you just sort of look to the right there, some of these companies we've all heard of and all use on a daily basis, these stock prices have gone down extraordinarily.
Thanks, Alan. It's obviously been a year of turmoil, and I think at times it's been really challenging, not just for the average consumer out there, but even for professionals to really understand maybe what's real versus what's the proverbial noise. As many have noted out there, you know, and you hear this if you tune into CNBC or read financial press, but there's an acknowledgement right now that there's really very few investment managers in the business today that were alive, let alone managing money the last time many of the market factors that you just outlined have been present. You know, it's been, in many cases, 40 plus years since we've seen things like higher inflation and maybe a rising interest rate trend. So in that vein, what have you and your team been doing this year, and what's that experience been like in working through really what's the first in a generation sequence of market events here?
Well, we have to start by trying to take a realistic view of where we stand. And we don't profess to be able to predict the future. What we can tell you, though, is where you stand right now, and historically, how has that type of positioning fared during a period of inflation or high valuations or shifts in the Federal Reserve. All those things do have big impacts on the prices of assets. So the way that we've been positioned is that we've had more cash because we want to maintain liquidity in case of client expenses. And we also want to have some ready cash available in case there is a market drop. Not that we're able to predict market drops, but the more prepared you are, the more success you will have over your lifetime. So having a little bit of extra cash on hand, just in case there are opportunities available. We've reduced our exposure to domestic equity because of the elevated valuations in the United States, because of the Federal Reserve printing money due to fiscal stimulation, due to the possibility of inflation. We've increased our international exposure because of those same factors. And then also because there are much better valuations in the rest of the world, especially in Europe and Japan and those type of areas. We still want to be very careful about political climates. So we have zero exposure to China because we don't necessarily trust that we're going to be treated fairly as shareholders But as long as there are fair political circumstances, we would look at international equities to take advantage of a declining dollar over time. And the more money we print, the lower the dollar should go in value. We've limited ourselves to very short-term, high credit quality bonds. That's actually paid off this year because there have been fluctuations in interest rates, and a lot of longer-term or lower credit quality bonds have done poorly this year. So our bond exposure has been relatively neutral. We've increased our alternative exposure because our stock and bond options are limited. So we've added some strategies that aren't necessarily just owning stocks. We have funds that invest in merger arbitrage opportunities. Those are extremely safe situations. Your main risk is that a deal is going to fall through, and they're not tied to the stock market. So those merger arbitrage type situations actually do better in rising interest rate periods. So if there are rising rates, we should have an advantage there. We've also added some long short opportunities, which means that the fund manager can sort of buy stocks and sell stocks short to take advantage of a market drop. And then we've also added energy exposure. There's a large shortage of energy inputs in Europe and other areas, and especially during periods of inflation, energy has typically done well. And right now, energy is the lowest percentage of the S&P it's ever been. I think it's less than 2% right now, whereas technology and communications are 40% of the index. So let's just take a look at how we feel like we've done. I mean, we want to take an honest and real look at how the way we've been positioned for this year have played out. Not that means we need to make changes, but we need to sort of see how we've responded to these conditions. So cash has been a drag on returns, right? We've held more cash than we have historically, and that has had a little bit of a drag because the technology sector has continued to outperform. We don't expect that to continue, especially if inflation continues to rise, and especially if rates rise. You'll see a fairly negative correlation between technology stocks and interest rates because most of them don't earn money in the present. They are expected to make money decades into the future. And when you use discounted cash flow to measure that valuation on a stock like that, low interest rates have a magnifying effect that make it look like they're worth a lot more than they are. So interest rates started dropping on us in June, which has impacted our performance. We're positioned for inflation and we're positioned for rising interest rates. And that doesn't mean we won't make money if those things don't happen. We still try to maintain a balanced allocation, but we have a definite bias towards inflation, which is late, but is definitely here. So there's no way you can look at a 6.2% print and say that we are not experiencing inflation. Our alternatives, especially silver, have detracted from returns. We continue to think that those are good places to be in periods of inflation, especially when the U.S. is printing a lot of money as the only reserve currency. So we do want to maintain our alternatives exposures, even though they've been just a little bit painful this year. Our equity performance has actually been extraordinary, but our allocation to equities has been lower than usual. So our security selection has been very good. It's just that our allocation has limited our exposure to equities. If you break down the average equity returns, they're in the 22 to 25% range. But when you only have 25 or 30% exposure, and then you've got a little bit of a drop on the alternative side, it has a tendency to skew the short-term returns, especially if you're looking at returns of less than a year. The international equities have underperformed our U.S. large cap growth. That's sort of laid out by that. Look at the 41,000 stocks out there, and if you take out 300 of the U.S. growth stocks, the returns have been flat. We still expect international equities to perform well over time, so we don't want to make any changes there. Our energy exposure has increased our volatility. It shot up a lot early in the year and then has sort of languished as there's been this argument about whether or not there's inflation. And then our bond allocation has been flat because we've avoided interest rate and credit risk, and maybe slightly negative in some cases, but we expect that those negative returns to work out as bonds mature. So if you own a 30-year bond and it drops significantly, it's going to take a long time for that to come back. But if you own a 2-year bond and it prices down due to an interest rate rise, you'll get that money back within 12 to 24 months. So just in summary, I think that if we look at the data, if we look at the circumstances that we exist in right now, it looks like we're still positioned for success, even if we've been early. Someone asked Meyer Rothschild one time why he was so rich, and he said, because I'm always early. And I know that there's a very thin line between being early and being wrong, but when circumstances are continuously changing, it doesn't mean that we shouldn't still be positioned the way that we were for those circumstances that are coming a little bit later than we thought that they would. We still feel like inflation is here. We feel like interest rates should respond to that over time. And the way that we're positioned is very flexible. If for some reason inflation disappears overnight and rates drop, we have a lot of cash, we have a lot of assets that should preserve value. And if circumstances change, we will change our minds. I mean, we aren't married to the positioning that we're in right now. We just feel like it's still the correct way to be positioned for the circumstances that we're facing.
Great, thanks, Alan. With the conclusion of your remarks, we're going to go ahead and transition here into the Q&A. Just as a reminder for anybody in attendance, if you have any questions that you would like to ask, you can click on the Q&A button at the bottom of your screen and type those in, and we will try to get to them. Obviously, just a brief reminder, if you do have questions, because of client privacy requirements, we can't address anything that's client-specific or account-specific in this forum, but we will pull those and address them individually offline after the conclusion of this webinar. And of course, we always encourage you to speak with your advisor on things that may be specific to your circumstance. So, Alan, I do have one question here that came in actually a little while ago on the screen when you were talking about allocation. And it says, it looks like Basepoint's currently carrying a lot of cash in its models. Today, cash is having a hard time keeping up with inflation. Is carrying so much cash a concern for performance? And at what point will a market correction cause Basepoint to put that cash into the markets?
Sure, I mean that's a great question, and it goes. The answer goes back to what I said about the difference between asset inflation and goods inflation. And if we do get an increase in interest rates in response to inflation, asset prices will decline. And even though we're getting zero in cash, that's significantly better than minus 30 or minus 40. And that gives us an ability to buy securities at a discount. So I would much rather take a 6% negative return over 12 months and be able to buy securities at a 40% discount than to own those securities as the discount is being built in. And then, you know, if our purchase decisions are always based on valuation. So if we're able to get good returns on equities, on an earnings yield, and then also as a discount to fair value, then we will aggressively move money from cash to equities. And that sort of played out in March of 2020 when the COVID decline happened. We put a significant amount of cash to work, and we were lucky enough that we had a lot of cash. So a lot of our clients experienced large gains because we had cash on the sidelines ready to put to work.
Great, thanks, Alan. Kind of maybe a follow on that just came through as a question, and I think you hit on maybe parts of this, but one of the things that you referenced early on today is that in general, our asset allocations are not static, that they evolve over time based on facts and circumstances that are out there, which is sort of a unique approach to asset allocation with how the industry has shifted over the last 30 or 40 years. Can you talk a little bit about maybe how an allocation might shift as markets and the economy in general maybe move through its machinations? Obviously today, those allocations are carrying a little additional cash for the reasons that you just outlined. But what did that look like maybe back in 2019, 2020 when markets were hitting record highs? Obviously, you just mentioned some steps you took in March of 2020 when it dropped off But what are maybe some driving factors that you're doing, or some driving factors that are influencing your decision around those asset allocation models?
Sure. Well, as we said in the front half of the presentation, our base model is 60% equity, 40% fixed income or other things than stocks, for an average 45 to 75-year-old investor. I would say that equities are fairly valued 90% of the time. We just happen to be in one of those 10% periods of time, which were sort of laid out by those charts that we showed earlier, that we're at extreme valuations, and that's why we've deviated from that baseline allocation. But if we get back closer to sustainable valuations on equities, we will definitely increase our equity exposure by quite a bit. So what I'm looking for is closer to mean valuations. And also, so I want to look at relative valuations to history, and I also want to look at absolute valuations. So I also want to make sure we're getting a fair return, right? So on an earnings basis, 3.3% or whatever that number was, 3.14, is way too low to have significant exposure, when what we're trying to do is preserve capital. And so we have a tendency to be very aggressive when the market's going down and more conservative when the market's going up. And I think that hundreds of years of history have shown that ends up being the right answer. I always tell our financial analysts that, you get to look smart before a market goes down or after. And unfortunately, you have to make that decision. And we would never try to predict what the future holds. But what we can do is respond to the circumstances as they currently exist, and then make a judgment on what's more important. Is it more important for us to get 8% instead of 6%? Or is it more important for us to avoid a 30 or 40 or 50% loss? And I don't think there's any question here which one of those is more important. So the dynamic skew of those two different decisions is so lopsided that it's, we have to try to preserve capital when everyone else is sort of clamoring for those last gasps of a bull market.
Great. Thanks, Alan. I've got one other question here, and this is one that obviously is in the news a lot. Does Basepoint use Bitcoin or other cryptocurrencies as a hedge for inflation?
We don't, and mostly because it violates our first two principles. There's no way to put a valuation on something that doesn't generate income. So if you fit, and I'm not a crypto expert. I don't have a degree in mathematics from MIT, but I am an investments expert. And what I can tell you is that Bitcoin is the monetization of energy. You have tens of thousands of computers trying to calculate algorithms. And when someone solves one of them, it posts the transactions to a ledger. And that's what causes one person to be able to transfer their value to another person. And that's very expensive. It's something like 500,000 times more energy intensive than a single credit card transaction. Processing a single block of transactions uses the same amount of power that it can run a house for a month. And as we get closer to this shift to green energy and this demonization of fossil fuels, there's going to be a choice that has to be made here, because Bitcoin is highly energy intensive, and that's pressure directly on our power grid. And you've seen countries like China outlaw it altogether because they're having trouble keeping up with the demand for energy. And then you also have a transition of value from developed economies to developing economies. You saw some countries in South America start to use Bitcoin as currency. Well, what you're doing is you're drawing on the energy grid of the US, because a lot of the Bitcoin transaction processing is moved to Texas. And so you've got this sort of free ride aspect that's going on right now. And unfortunately, I think that the biggest risk here is that gets regulated out of existence in the future.
Great, thanks. So I've got one last question here. We're kind of approaching the hour mark, so I'll get this one in, and then if folks have other questions, we'll aim to take those offline. This question kind of has to do with market circumstances and maybe tied into some of the latest headlines around the COVID variant and concerns over maybe renewed restrictions within the US, but maybe more so globally. And the question is, are supply chain issues still a concern leading into 2022? And what happens if some of these global reactions to the latest variant, or maybe one yet to come, results in additional constraints on that moving forward?
Sure. Yeah, I definitely think supply constraints are still an issue. And, when we laid out our thesis for COVID, supply constraints were one of the major risks that we highlighted at the time. I don't think that they ended up being as bad as we thought that they could be. But I still think we're positioned, and a lot of those supply chain constraints are going to translate into inflation. And as we talked about in the presentation, that's how we're positioned. I would say that if those type of risks continue to materialize, we're positioned in the right way for that to happen. We've got significant amounts of cash. Our equity selection is very selective. We own companies that produce goods that are needed. We don't own a lot of companies that their products are based on the economy increasing. So we don't have a lot of travel. We don't have a lot of leisure type activity stuff. We've got things that people buy, whether they're sequestered in their homes or whether they are able to live their lives as normal. And then we also, we're positioned for rising interest rates, which supply constraints would continue to exacerbate those type of problems. And then we've got, precious metals and non long only equity strategies that should also benefit from any future dislocations.
Great. Thanks, Alan. And with that, that was the last of the questions that have come through at this point. I'm sure there may be others out there. And again, we would encourage you to reach out to your advisor. They are always ready and willing to answer any questions. And one of the great things of being locally owned and operated is Alan and his investment team are sitting right down the hall from the advisors and are always available when questions arise. So again, we want to thank everybody for attending today and joining us for this discussion. Certainly, we'll be looking to do more of these in the future. And if you have any feedback or related questions to today, please feel free to reach out and communicate those at your leisure. We appreciate it and wish everyone a Merry Christmas and a Happy New Year.